Is this a Teflon tape?
Well, there are a couple of things going on. With respect to the coronavirus, you have to weigh what's short-term versus what's long-term. And I think, there's obviously a very significant human element here, but in terms of the economic impacts, most of them are short-term, and so really shouldn't affect the valuations of companies. Long-term, I think we really have to think about supply chains. I think we've had this lesson twice, the trade war, and now the coronavirus are telling you if you have a company with a concentrated supply base, that may be good for margins short term, but it creates risks. And so companies and investors need to think about that issue.
So we're heading for our 11th record close for the S&P of 2020. How do valuations stack up at this point?
So look, the S&P is at a 19.2 multiple. That's pretty high by historical standards. But you also have to look at interest rates. The interest rate on the 10-year Treasury is 1.6%. That's also extremely low. And you actually have a higher dividend yield on equities than you do on bonds. So the S&P has a dividend yield of 1.8%, the 10-year Treasury 1.6%. That's unusual. So while stocks do look expensive by their own historical standards, they're cheap when you consider the prices that bonds are trading at.
Well, from a portfolio construction standpoint, though, it is a little bit dangerous to say you're earning 1.6 on a 10-year Treasury. You can get 1.8 in S&P yield. You can pick like maybe a telecom company with a 4% yield, but you could lose 20% on the equity side. A bad day for stocks is a bad year for bonds. Like the volatility profile, very different. So,
well, what's interesting though is if you look at bond volatility has been rising and stock volatility has been falling. Now there's still a gap, but that's what we're seeing on the volatility side. I agree in part with your point, and what I would say is it's really important for investors to be selective, to know what they own, to be prudent, to focus on quality, to focus on good balance sheets, because you got to think more about downside protection when valuations are high.
One of the problems, though, with focusing on quality is you get into the NASDAQ 100 names that are already up 100% over the last year, and they're the biggest market cap. Those are the highest quality names.
But they keep going up.
They keep going up.
Yeah, so, as a fundamental investor, our job is to find underappreciated quality that people are
Where are you finding that right now?
We saw the HMOs today, up a lot. I think that's a really high-quality sector. It grows. Healthcare grows as a percent of GDP. They grow. They have high returns on invested capital, good share repurchases, and yet dividends.
They have political risk, though.
They do have political risk, but when you kind of walk through the analysis, I think the political risk is actually low. There'll be a lot of noise and a lot of headlines, and there'll be stock price volatility. But I think at the end of the day, we'll have gridlock, no matter who the president is, and not much will change.
What we're not going to have gridlock on is where the Fed's policy seems to be, right? That's well defined and reiterated yet again today by the Fed chair himself on the Hill. So I look at the notes that you have for us today, and the reasons for optimism are about half the size of the reasons for caution. What happens if those cancel each other out completely, and it's simply the guy in the suit with the glasses on sitting there in front of the Senate today who says we'll be aggressive with all of our policy tools if we need be, and that's all that really matters at the end of the day. That's worked for 10 years. It's going to continue to work until it doesn't.
Without a doubt, the Fed is helping to support the market. That's what's keeping interest rates low. That's what's keeping valuations high, and they've told you they'll be supportive. There's also a lot of money on the sidelines, right? Whether that's in money market accounts or private equity, right? That private equity money has to go somewhere. I think you'll see a lot of buyouts of public companies.
You think it's all about the Fed? At the end of the day, no matter what happens, that seems to be where the optimism lies and why some would suggest it's, let's say global central banks.
Yes. So without a doubt, that's very supportive. You also have to look at fundamentals, and I'd say fundamentals are pretty good. We have earnings growth picking up. We've just had a pretty good earnings season. Estimates for 2020 guidance looks pretty good. So I think we are in a period of improving earnings per share as opposed to declining. Notwithstanding,
albeit slightly,
but good to improving fundamentals. A strong consumer, wages are growing, employment's growing. The consumer is 70% of the economy. Obviously it's been a long cycle.
Yeah.
But I don't see the end.